So, welcome. My name is Camilo. Let's talk about this infrastructure bond that is happening for the March sale. And we'll briefly go through a couple of things on requests from my followers who feel that a video version of the explanation that I give on these investments will do them good so that they get to understand them. So let's just dig in. And basically, a prospectus is an invitation to invest. And this invitation is to all eligible investors. That is someone who is holding a CDS account with CBK, and this CDS account should be active for that matter. And the offer is an infrastructure bond of 17 years, and we call it amortized, though in the terms and conditions of the bond, we'll be able to see why it is amortized, and other bonds, such as fixed coupon bonds, are not amortized. So from now onwards, this bond will be referred to by its issue number, and that is IFB1 2023 stroke 2017. So if you are referring to this particular bond or any other bond, and you want maybe to talk with your bank or investment banker or your consultant, or talk to me regarding a particular bond. So now from onwards, we start referring to the bonds as per the issue number. This will be better because I'll be able to know what bond you are talking about. So the CBK wants to raise the 50 billion, and as I said, this is a March sale, since auction and payments will be happening in March. Though we have been given time, since the advertisement of this board, it happened on 15th, today being 18th, we'll have up to 7th of March to apply for that particular bond, and we'll be paying for that bond by 13th. That will be the payment date and also the value date, meaning the bond will start accumulating interest on the 13th of March. So that is the March sale. Without further ado, let's talk what this bond here entails. And it is central bank acting on behalf of the Republic of Kenya, and they want to raise 50 million meant for funding infrastructure projects for the financial year 2022-2023 budget estimates. And this bond will be a 17-year bond. And as I said, maybe to take you back, you are eligible to participate in this bond if you have a CDS account with the central bank, and your account is active. So many people get confused between CDS account with the central bank and the CDS account, CDS account that they opened when they were trading in the Safaricom IPO or any other IPO for that matter, or when they were purchasing shares. So the CBK CDS account is used to trade bonds in the primary market. That is between the issuer, central bank, and yourself, the investor. On the other hand, the CDS account, that is the Central Depository and Settlement Corporation CDS account, is used to hold your securities. Those may be shares, talk of bonds in the secondary market, corporate bonds and such. So the CDS account is what you open with an investment banker or a stockbroker for that matter. And that one will not be used to trade bonds with CBK directly. So let's get past the issue of the eligibility. Now let's talk about market determined. That is the coupon rate. You say it is market determined. I'll get back to the tenure. No need to worry. But let's just briefly talk about the coupon rate being market determined. And this means that after an auction process, these treasury securities, that's bills and bonds, they're offered through what we call an auction process. So every investor is submitting their desired rate of return. And these are competitive bids. These are what we call we term as competitive bids. And if you are going for a competitive bid, please make sure that you are experienced in placing competitive bids. And there are a couple of factors that you'll be looking at: inflation rates, the real rates on that is the real rates on loans and everything. You'll also be looking at past performance of these securities so that you're able to bid correctly. Uh, Make sure you have experience in bidding because you don't want to shortchange yourself in this bidding. If you are not very confident about the bid you are to place, I always advise newbies and anyone who doesn't have experience in bidding, just go for non-competitive bidding. And in your application, what shows that you're going for non-competitive bidding is indicating zero. So that should be it. So after we have submitted our bids, all competitive bids will be compiled together. We come up with a cutoff point. We take the weighted average rate, and this weighted average rate of the competitive bids is what is allocated to everyone as the coupon rate. So this is what it means that the coupon rate is market determined. So there's that period of sale. So I said from 15th to 7th of 15th of February to 7th of March, you can submit your application on those particular dates. Then we'll pay after the submitting the bids. We'll get results on either 9, 8th or 9. I won't go for, I won't explain that again. So you'll get your results either on 8th or 9th of March, and then we'll have a few days there to pay for our bonds, our allocated bonds, and that is by deadline 13th of March. We should have all paid for our allocated bonds. So the minimum investable amount, anyone who is looking forward to invest in these bonds, the minimum investable amount you can invest is 100,000. I always hear people asking me how much they expect to earn from these particular bonds. Let's take an example of the IFB1 2022/14. That was the infrastructure bond one of 2022/14 years, which was offered in March, not March, November last year. So basically, what happens with that bond? It attracted an interest rate of 13.938. So if you had done the minimum amount, investable amount of 100,000, so every year you're expecting 13,938 from that particular bond. Now, though the interest paid on these bonds is paid semi-annually, so half the amount, half the interest that you are to earn is what you will earn every 6 months. So you divide that by 2, and you expect that amount every 6 months. So here is the interest payment dates, because we have said every 6 months you are receiving something. So from the value date to this date, 182 days. So 6 months, you receive your first coupon payment or interest, have the interest that you are to earn annually. We term that as coupon. So you'll be receiving coupons every single date on this schedule. So, and also we use this schedule to for people who are investing, you have a client relationship, we create what we call a coupon schedule. It is meant to guide you on how your earnings will be. So basically, you you can create that schedule. You just pick the dates. If you don't know how to, you can request someone to do it for you. You just have the dates, and you indicate how much you're expecting. It is a good way of planning. So if you are investing the interest in what we term as compounding interest, so you earn whatever interest you're earning, maybe it is a couple of shillings, then uh, you're able to you're able to plan what you to expect when, so that you can maybe invest that money or use it. So that is it. Let me talk about redemption structure. Then the redemption structure on these infrastructure bonds, which is started by saying they are amortized, kind of confuses some people. So let me explain it in a layman's language so that it is understood by everyone. Now, when we talk about amortization, we are talking in regard to the principal that you paid. Ordinarily, in fixed coupon bonds, you give the coupon rate maybe 100,000 or 50,000 or whatever the amount you have invested. You give that and expect it at the end of or the maturity of that particular bond. But in this case, what we are looking forward to is where we say the bond is amortized, in that part of the principal can be paid throughout the tenure or the term of the bond. So we have seen this is a 17-year-old bond. So what you are being told is part of the principal will be paid halfway the bond, and that will be in 2033. That is around 10 years after the issue. And then the balance of that principal will be paid now at full redemption. That will be in 2040, 17 years from the issue date. Now, there's something you're going to have to note, is that if you have amounts of 1 million or below at amortization, that is by 2023, when we'll be doing the first redemption, if you have amounts of 1 million and below, this amount will be, you'll be paid your money in full, and you're asked to leave the party, just like using that word. Like if you have amounts of less than 1 million, so if you're investing 500, 250, you'll in 2023 you'll be given back your full principal, and you're told to leave the party. And note, you will not continue earning interest on that particular bond since you have your principal back. So there are people who thought that they will continue earning interest. Not really. You will be given your money back in full and told that is it. So basically, that should be it for anyone with amounts less than 1 million. Let's talk about anyone who has, let's say, amounts above 1 million. For example, you have invested 2 million in this particular bond. So in 2033, that is 28th of Feb, you will receive part 50% of your principal, and that should be, if you have 2 million, that will receive back 1 million. So from the start of this bond, you will earn interest on 2 million up to 28th February 2033. You receive back your 50% principal. And when that happens, you will now continue earning interest on the balance. That is, you had 2 million, you have received back 1 million. So you'll earn interest on the balance, that is 1 million. Now until redemption date, that should be 2040. So that should be it in regards to the redemption structure. Now, another word that maybe people don't get is unencumbered. So maybe you already know that we can create a lien against the bond that you're holding, and that is you can borrow against that bond. When we create a lien, is now telling the holder of that particular bond, for example, it is a central bank who is the custodian, not to release the bond for sale or transfer, since we have borrowed against that bond. So you can take a loan against your bond. And when that happens, we will say that your bond is encumbered, all that it is not loan free. So when we are talking about unencumbered, we are talking about a bond that is loan free. So basically, what we are saying in this redemption structure is that we will redeem when we are doing partial redemption, that is 2033, we'll only redeem what is loan free, that has not been used to borrow loan. So we cannot refund, you won't be refunded back your money when you won't be refunded your money when maybe like you have a loan against your bond. So maybe it is important to note that. Amortization, that I think should be clear, in that if you invest 1 million and below, and provided you have not borrowed against it, you receive back your money in 2033. Or on the other hand, if you have amounts of more than 1 million, 50% will be repaid back in 2033, and that is if you have not borrowed against it. And then the remainder will be repaid back in 2040, that is full redemption. that maybe should be clear light now. So let's maybe there's nothing much to talk about that bond, since we had done the interpretation of prospectus, because all the other terms I think I've talked about the dates of submitting bids and deadlines of payment and everything. So I think that should be maybe understood by now. So that is it regarding the infrastructure bond of IFB 1 2023 stroke 2017. And as usual, I like parting by saying that every investment involves some form of risks. So, and for these particular investments, they will talk about maybe liquidity risk, and this is where you are not able to liquidate your particular security or that investment. So, if you need your money before maturity, so the liquidity risk is whether you will be able to sell your bond or transfer it to someone else when you need to, because bonds are tradable securities. So there's that risk of you might not get a buyer when you need to, or that might delay. There's also the risk of default, like, but currently we are not looking forward to the government defaulting totally. What we are looking for refusing to pay. What we are looking forward to is restructuring of these debts, where you are holding short-term security, and they restructure that to maybe extend the term of that bond. This has happened in the past where holders of treasury bills, they have been restructured, and instead of getting your principal back, you are offered a longer term security on its place. So December last year, some people who were holding, some investors who were holding some treasury bills, were offered an infrastructure bond of 6 years in place of those maturing securities. So these are some of this risk that you are looking forward to investing in these government securities. And as usual, the main ways of mitigating risks is where you diversify your investments. No single investment will ever achieve what it is that you want to, and no single investment opportunity will guarantee you that it is risk free, and at the same time give you a better rate of return. So diversification is very key, and you can diversify within the asset class. Maybe that you can diversify within the government securities, and you can diversify across various asset classes. So that should be it in regards to these government securities and the infrastructure bond on offer currently. So if you would want to learn more in regards to these government securities, that is treasury bills and treasury bonds, and any other capital markets investment currently allowed in Kenya, I would invite you to our personal finance class, which we are hosting every month. So we'll be having our class starting this 6th of March. And I've mentioned you learn everything regarding treasury bills, treasury bonds, investing in the stock market. You'll also learn about all these unit trusts, those are money market funds, fixed income fund, balance funds, and all other funds and the unit trusts. We'll also learn about investment diversification and how to reduce the risk, to mitigate the risks that you are looking forward to in these all other investments. And we have added a unit that is emerging trades, since now we have money managers. We have products by money managers. We have like 2 licensed money managers in the country who are advertising their funds. So you need to understand what are the risks that are associated with these investments and how you can add them to your investment portfolio. There also another emerging trend that is coming out is right now, so many applications at the desk of the Capital Markets Authority, and this is in regards to real estate investment trusts. And people are wondering, are these good investment vehicles or good investment opportunities to go for? So basically, we'll also be learning about them and the best practices in investment. We have something that we always do in all these investment options, and that is conducting due diligence. So you'll also learn how to conduct due diligence, diversify your investments, and risk management. So my name is Wakamilo again. If you want to join our class, you can always WhatsApp us on this number, that is 0758 007979. For more details, let's register you for our upcoming class. Come and join our good students who have really benefited from our classes. Thank you. Adios and all the best.